Welcome to vTalkInsight, Risk Sentiment Daily for January 21st, 2026. After one of the sharpest equity pullbacks since October and a surge in volatility, the question now is whether this is just a shakeout or the start of a deeper de-risking phase. Let us unpack what is driving risk appetite across bonds, equities, and alternatives, and how the balance between fear and opportunity is shifting. Risk sentiment has swung decisively to risk-off after a sharp sell-off in U.S. equities and a clear spike in volatility. The S&P 500 dropped about 2% in its worst session since October, while the VIX pushed above 20, signaling a meaningful rise in hedging demand and downside protection buying. That move aligns with earlier warnings that investor positioning was extremely bullish, cash levels were low, and markets were priced for a very benign outcome across multiple risks, leaving little margin for negative surprises. Compared with the broadly risk-on, late-cycle tone seen last week, today's backdrop is notably more defensive. Global bonds are selling off, equities in the U.S. and Europe are under pressure, and safe haven flows are concentrating in gold, silver, and the Swiss franc rather than in treasuries or the dollar. Investors are modestly trimming U.S. exposure, adding to cash and short-duration income vehicles, and rotating tactically into non-U.S. markets, all consistent with a desire to reduce beta without a full capitulation. What makes this episode unusual is that it is not being driven by a collapse in growth data. U.S. economic indicators still point to solid activity, inflation below 3%, and easing rates, and markets expect the Federal Reserve to cut policy rates later this year. The stress is instead coming from a global bond yield shock, escalating trade and geopolitical frictions between the U.S. and Europe, and growing concerns about U.S. fiscal sustainability and the role of the dollar. Those forces dominate near-term sentiment, even as a resilient macro and an AI-led investment cycle continue to support the medium-term risk backdrop. A central bearish driver is the global bond yield shock and volatility triggered by Japan. Japanese long-dated government bonds have seen highly unusual moves, with some maturities rising around 40 basis points since late last week and price action approaching for standard deviations. Yields on Japanese bonds have even pushed above German levels, a rare configuration that is forcing investors to reassess relative value, hedging strategies, and cross-border bond allocations. This stress has spilled into global fixed income, most visibly in U.S. Treasuries. 10-year yields are approaching about 4.3%, breaking out of a long-standing range, while the curve is steepening as long-end yields jump. Market participants link this to both Japan-related flows and domestic concerns around U.S. fiscal deficits, debt sustainability, and the risk of weaker demand at future Treasury auctions. For portfolios, this yield shock tightens the screws on duration risk and raises the bar for risk assets more broadly. Higher long-end yields, without a corresponding flight to quality, can pressure equity valuations, particularly in rate-sensitive sectors, while also increasing funding costs for governments and corporates. At the same time, a higher term premium and still tight credit spreads create a more nuanced fixed income landscape, where investors are focusing on quality, liquidity, and the potential for further volatility if Japanese policy expectations or U.S. fiscal worries intensify. The second major headwind is escalating US-Europe trade and geopolitical risks. The U.S. president has threatened new tariffs on European allies, including levies that could climb from 10 to 25% on countries deploying troops to Greenland, alongside the prospect of a 200% tariff on French wine and champagne. European Union officials are now openly considering withdrawing from existing trade agreements and preparing retaliatory measures, pointing to a potential full-blown transatlantic trade conflict. Markets are already reacting to these tensions. European equities are experiencing broad-based selling, with luxury goods and financials underperforming as tariff and sanction risks bear down on globally exposed franchises. Major institutions have started to downgrade the region, citing the combination of trade frictions, policy uncertainty, and the risk that Brussels-Washington relations deteriorate further. These trade disputes are layered on top of wider geopolitical strains, from disagreements over Gaza diplomacy to Arctic security and Greenland. In Nordic countries, previously pro-American populations are protesting and reassessing their economic ties, and some European pension funds are debating whether to reduce U.S. exposure, even if actual divestment remains limited so far. All of this lifts the geopolitical risk premium embedded in assets, particularly in Europe, and helps explain why risk sentiment has shifted so quickly from last week's constructive tone to today's more defensive stance, even as investors hope that diplomatic engagement at gatherings like Davos can eventually cool tempers. The third bearish force is the combination of de-dollarization, a powerful gold surge, and rising U.S. fiscal worries. Volatility has pushed traditional safe haven behavior into new territory. Gold and silver are hitting record highs, with gold around 4,750 and silver above 95, while U.S. Treasuries and the dollar are not attracting the same protective flows. Investors are increasingly favoring gold, the Swiss franc, and select hard currency emerging market debt as their risk-off anchors. Behind this move is a structural diversification away from dollar-denominated assets. Central banks and sovereign funds are increasing allocations to gold as a reserve asset, reflecting unease about fiat currencies and U.S. debt, and the outperformance of gold over U.S. equities over the past year signals a shift in global capital flows. Persistent trade and capital wars are eroding foreign willingness to accumulate U.S. treasuries, and some European investors are tactically trimming U.S. exposure and repatriating capital. At the same time, simultaneous declines in U.S. equities, treasuries, and the dollar are drawing comparisons with emerging market crisis dynamics. Rising treasury yields toward 4.3% against a backdrop of large fiscal deficits and concerns about potential auction failures reinforce the perception that investors now demand a higher risk premium to hold U.S. sovereign risk. While there is no immediate sign of disorderly selling, the combination of de-dollarization, a gold-centric flight to safety, and unresolved fiscal challenges poses a non-trivial medium-term risk for funding conditions and valuations across U.S. assets. Balancing these headwinds, a key bullish driver remains resilient U.S. growth and soft landing odds. U.S. stock indices have recently been at record highs, supported by multi-year peak GDP readings and unemployment near full employment, while inflation has eased back below 3%. Policymakers highlight strong economic and labor market data as evidence that, for now, recession risks remain contained even as markets grapple with volatility. On the policy side, markets expect the Federal Reserve to deliver at least 2 rate cuts this year, with some seeing scope for more if labor market softness outside healthcare persists. The term premium embedded in treasuries has risen, offering greater compensation for holding duration, and credit spreads in investment grade and high yield remain relatively tight, suggesting underlying corporate fundamentals are still viewed as solid. Equity investors increasingly see the market transitioning from a valuation multiple story toward an earnings-driven phase, which historically can support positive, if more moderate, returns. Household and corporate behavior reinforce this constructive backdrop. Consumer spending has stayed robust, helped by strong holiday activity and potential tax benefits from recent legislation, while business investment has surged, with capital expenditures reported up around 12% on the back of full expensing for equipment and factories. These dynamics provide a buffer against shocks from bond markets and geopolitics, and help explain why many observers frame the current episode as a volatility spike overlaying a still supportive domestic growth story rather than the start of a fundamental downturn. Another important bullish driver is the multi-year AI infrastructure and earnings cycle. Demand for AI compute is surging to unprecedented levels, forcing cloud providers and enterprises to ramp up investment in data centers, custom silicon, and power infrastructure at a pace the market has not seen before. Recent commitments for AI-related buildouts are reported in the trillions over time, and investment-grade issuance tied to AI capex alone is expected to run in the hundreds of billions, underscoring the scale of this cycle. This investment is already feeding through to revenues and earnings. Some AI-focused companies have delivered reported revenue growth of 300 to 400%, and major buyers are signing multi-year contracts for compute capacity and graphics chips, which can extend the economic life of AI hardware beyond what traditional depreciation models assume. Interestingly, valuation multiples for leading hyperscalers and semiconductor names have been compressing even as earnings rise, suggesting that part of the earlier exuberance has already been digested by the market. There are, of course, risks. Power availability is becoming a critical bottleneck for data center expansion, and some companies, such as certain software and infrastructure providers, face questions about whether heavy data center spending could strain balance sheets or credit ratings. Yet the breadth of end demand, the dominance of large, credit-worthy buyers, and the ability to repurpose older hardware for new use cases all point to an AI cycle that is more likely to be a durable, multi-year support for earnings and capex than a short-lived bubble, even if individual names remain volatile. The final bullish theme is global rotation, capital flows, and deal momentum. Global investors are gradually rotating out of U.S. equities toward Asian markets, with China, India, Korea, and Taiwan all attracting increased allocations as investors search for diversification and new growth stories. India, in particular, is viewed favorably thanks to its large, young population, rapid technology adoption, and relatively open, competitive economic model. At the same time, capital markets remain active despite the recent spike in volatility. Investment banking activity is strong, with major institutions reporting sizable increases in fee income and M&A volumes, while private equity exits have rebounded and are on track to surpass prior records as corporate buyers regain confidence. Individual companies such as Meta are tapping both internal funding and private credit partnerships to finance ambitious AI-related buildouts, underscoring the continued role of private capital in this cycle. These flows and transactions signal that risk appetite has not disappeared. It is being reallocated. Hard currency emerging market debt is favored over local currency exposures for risk management reasons, and selective sector and regional opportunities persist even as headline indices struggle. For portfolio construction, the key takeaway is that while the overall tone is risk-off in the short term, underlying currents of growth, innovation, and cross-border deal activity are still shaping a differentiated opportunity set across regions and asset classes. To sum up, markets are in a decidedly risk-off mood, driven by a global bond yield shock, escalating US-Europe trade and geopolitical tensions, and a powerful shift in safe haven behavior toward gold and away from traditional dollar assets. Set against this, resilient U.S. growth, expectations for policy easing, a multi-year AI infrastructure boom, and active capital rotation and deal-making continue to provide important support beneath the surface. Watching how these bearish and bullish forces evolve, especially bond volatility, tariff decisions, and the durability of the AI and growth story, will be critical for understanding where risk premia and correlations go from here. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.